Hey guys, what's up? Welcome back to my financial focus. In this video, I'm going to be talking about the protective collar options trading strategy. This is a strategy that someone would typically implement if they already owned 100 shares of an underlying stock, like in this case, Google. And they would do this to protect their downside risk in volatile markets like the markets that are happening today. So in this video, I'm going to talk about how we can open this strategy, what the purpose of the strategy is, and then when the best time to use the strategy would be. So thanks in advance for leaving a like, and let's get right into it. So as I said before, this strategy would typically be used by a trader who already owned 100 shares of the underlying. And the way they would do this is by opening a long put position as well as a short call position. So the long put position in this case, let's say that we wanted to protect our downside risk past $2,660 per share. So that would be the put contract that we would buy, our long put position. And then we would sell a call option that is also out of the money. So in this case, we might sell this $2,700 call option. And so after we're done doing that, we can see that we have our long put position with a premium of $4,125 and our short call position with a premium of $4,270. And so what this strategy effectively does is it protects our downside past the share price of $2,660 by opening the long put. So in the event that the share price were to drop below $2,660 per share, we would be protected because we bought this long put option for $4,125. And remember, a put option gives us the right but not the obligation to sell 100 shares of stock at the strike price of the put option. So let's say the share price dropped all the way to $0 per share. We would be protected with our 100 share position because we have a put option. And so that makes it so that we're able to sell our shares at the strike price of the put option. But in order to get protection, typically someone would normally pay a debit of the premium that is set here for the price of the put option. But because we went short on a call option for a premium that was larger than the premium for our put option, we end up experiencing a net credit position. And so we are effectively getting paid in order to open up our own personal version of insurance for our 100 underlying shares. And obviously, in this particular case, whenever we're writing a call option, we are obviously giving up the opportunity for potential gains above the strike price of our call option. Because remember, when we write a call option, what we're basically saying is that we're collecting $4,270 because somebody else in the market is buying this call option for $4,270. And as a result, if the share price rises above $2,700, the person who went long on this call option is going to exercise their right but not their obligation to buy 100 shares of Google at $2,700 per share. And they would do that because the share price is going to be above the strike price by that point. So if they buy in here and then immediately sell at the share price, they would experience their profit. But in our case, since we went short on this call option, we're going to be the ones who are selling our shares to the person who went long on this call option. So as soon as they exercise this call option and it's, say, in the money with the share price being above the strike price, then we would immediately sell our shares at $2,700 per share. So even if the share price of Google is at $5,000 per share, because we went short on this call option, if the person who went long on this call option exercises their right to buy shares, then we would be forced to sell it to them at this price, even though at that point the share price could be $5,000 per share. So the upside potential between the strike price of the call and the actual share price is everything that we would miss out on because we would be selling our shares for $2,700. And so by giving up our potential upside by writing this call, we're collecting a premium for that right from the person who would have went long on the call option. And so as a result, what ends up happening is we open this position where we protect our downside, but we're able to do it for free, or in this case, actually get paid to do it because we're experiencing a total credit from the premium of the call option above the premium of the put option that's protecting our downside. And so typically, when this strategy would get used with the person who would be owning 100 shares, we wouldn't be experiencing a graph like this because we would already own 100 shares. So there would be no such thing as like unlimited max loss or something like that. Because remember, the reason why this says unlimited max loss is because it's looking at this strategy from the perspective of someone who doesn't already own 100 shares. And so if somebody didn't already own 100 shares of this protective caller strategy and they just opened this up with a naked put and a naked call option, then theoretically they would have unlimited loss because the share price could rise forever. And if it keeps on rising and they have a short call option without 100 underlying shares, that means that if the person who went long on this call option exercises their right to buy, we would be forced to buy 100 shares of Google at the current share price. Say it's like $5,000 per share, and then we would immediately have to sell it to the long call option owner at $2,700 per share. And so theoretically, since the stock price can continue to rise, that's why it says that our max loss is unlimited, because we would be forced to buy high and sell low. But obviously, if we already have 100 shares, then we're not going to be facing that problem because we've already bought our 100 shares. So we're not going to be buying high or selling low. We're going to be buying low and selling high, just maybe not as high as it could have been. And then the reason why it says max profit here is $266,000 is because it's looking at it from the perspective, again, that we don't already have 100 shares. And so if we didn't already have 100 shares, but we had a long put option, then that would give us the right to sell our 100 shares that we don't own yet at $2,660 per share. And so theoretically, if the share price dropped to $0 per share, we could buy in at $0 per share and then immediately sell it at $2,660 per share, which is why it says that our max profit would be $266,000 because it's the strike price of the option times 100 shares. But like I said, with the protective caller strategy, we already own 100 shares. So this long put option would more so just be protecting us from our downside risk as opposed to being an actual short position that we would profit from long term. And so that's basically the purpose of this strategy, is just to allow us to protect ourselves from downside risk without actually having to pay premium for that insurance, because we're collecting premium by selling insurance to someone else who wanted to buy that long call option. And so last thing that I want to point out is when the best time to use a strategy like this would be. And it's actually in a time like right now with volatile periods in the market that we've seen as a result of recent earnings announcements, like with Facebook and Netflix. I think their share prices decreased by like 20 to 30% or 40% or something like that for both of them, as well as unpredictable outcomes from macroeconomic events like Russia recently thinking about potentially invading Ukraine. And then also there was the report that came out the other day about the 7.5% inflation rate in the United States at the moment, which is the highest it's ever been in the last 40 years. And also, let's say somebody owned like 100 shares in Alibaba, they might want to protect themselves from the potential of future regulation from the CCP on Chinese tech businesses. And so if they own 100 shares of Alibaba and earnings come out or a regulation announcement comes out and it sends the share price flying downwards, then if they own a protective caller strategy, they would be able to protect their downside while still collecting premium from a total credit by selling call options that are higher than the current share price. So in situations like that where people are unsure about the future of markets, it would be ideal to use that strategy.